This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Welcome to the Financial Standard podcast. I'm Financial Standard journalist Andrew McKean, here today speaking with abrdn Senior Investment Director and Portfolio Manager, Nick Robinson. We're going to be talking about the current state and outlook for emerging markets. Welcome, Nick. Great to have you on.
Thanks, Andy. It's a real pleasure to be on today.
So, look, firstly, Nick, let's start from the top. Let's talk about, diving into the current state of emerging markets. If we're comparing it to, I guess, the MSCI World Index, it has been lagging. So, why has this been the case? And is it due for a turnaround?
Yeah, no, good question. It's been a pretty grim time to be an emerging market investor for the last decade. Earnings growth in that decade in emerging markets has been pretty grim, 6 or 7% each year annually. So it's been pretty tough. That's been weighed down by weak economies. The Chinese stock market in particular has been very weak over the last 3 or 4 years. Looking forward, there are a few things on the horizon, though, that are likely to change the outlook. Firstly, there's this kind of really strong valuation argument today for emerging markets. Emerging markets are trading on about a 13 times forward multiple, which is about the lowest I've ever seen it in my career. Meanwhile, the US and MSCI World indices are all trading on about 20 times, if not more. So there's a real valuation differential, which is interesting. I think, there's some kind of cyclical reasons behind emerging markets improving going forward. So we're very close today to the Fed starting to cut rates again after several years of hiking. That's usually good for emerging markets. Emerging markets tend to perform well when the Fed cuts rates because essentially that weakens the dollar. A strong dollar is tough for EM. We've had a very strong dollar in the last decade. Also, cutting rates by the Fed allows emerging market central banks as well to cut rates. They don't have to worry so much about protecting their currencies. And that stimulates local kind of domestic demand within EM. And then I think thirdly, the final point about why EM could potentially do better going forward is, EM tends to perform better when global capex is rising. The last time we had a sustained period of EM outperformance was that time period from around 2002 to 2010, when global capex was rising, being driven by the big kind of China infrastructure build out. A lot of that money ended up in emerging market company bank accounts. We're seeing global capex increasing again quite significantly for the first time in quite a long while. That's really being driven by things like nearshoring, things like the capex investment associated with tech and associated grid infrastructure investment. And then we're also seeing capex being driven by green technology and the green transition to more sustainable sources of power and the like. So those things are all coming into play at the moment. So I think the combination of those three factors makes the outlook for EM a bit more interesting going forward than it has been for the last decade or so.
Well, let's dig into some of those points. So maybe starting from the top with the Federal Reserve's decision when it meets next month. So how important is that, on emerging market performance?
Yeah, I think it's pretty important. Certainly, there are emerging market countries which tend to be more sensitive to US interest rates. Those back in the last cycle were known as the Fragile Five. Some of those countries are in much better shape these days, like India, but certainly for economies like Brazil, for instance, which does run quite a big current account deficit, the US rate decision is quite important. And I think, it's one of those things that does, help EM countries, but also just improves sentiment towards EM. It's widely known that a strong dollar is tough for EM. A weakening of the dollar would be helpful. So I think, that sentiment, if that improves and people start allocating more money towards emerging markets again, that will certainly help the asset class. And the US rate environment is a piece of that puzzle.
Sure. And you also spoke about the upcoming US election as well. I guess how important is that in terms of, shaping the economic landscape for EM? Could you maybe discuss some of the potential policies from the respective candidates that investors should be paying attention to? Is it going to make what sort of difference can we expect, I guess, whether or not, which respective candidate wins?
Yeah, no, I mean, it's one of those things that does have an impact broadly on emerging markets, which is odd in a way when you think about it, because you should think that EM should be driven much more by the companies within EM and the decisions they're making, rather than the decision if there's a few thousand voters in Pennsylvania are going to make that will probably determine the outcome of the election. But the fact is, it does make a difference, particularly with a politician like former President Trump. So, he's been very clear this time around that he's going to enact 60% tariff increases on imports from China, which would probably have about a 1 or 2% negative GDP impact on China were that to occur. So I think on the face of it, were the Democrats to win, that's likely to result in a broad continuation of policy, which, I don't think has been that bad for emerging markets. Certainly there's hawkishness towards China, but, not to the extent of, what would occur under Trump. Although I think, it's probably not as simple as that, unfortunately, and that if were Trump to be elected, then, it's likely that the Chinese government would hold back less on stimulus in order to offset the negative impact of those 60% tariffs. So you might see quite a significant stimulus going into, say, the consumer sector in China, which actually might be beneficial for Chinese stock markets and certainly Chinese consumer goods manufacturers. So there's all sorts of kind of potential implications that the election would have. I think on the face of it, a Democrat win would be better for EM, but like I say, you never know what else might occur as a result of that could change the outlook.
And would a Democrat win be better just purely on the basis that it wouldn't have the same level of tariffs on China?
Yeah, I mean, I think that's probably the most significant issue. I think there'd be potentially other risks out there under a Trump win, in that, Trump is clearly not willing to tolerate the geopolitical status quo in terms of America's role in the world and the influence that the US has in terms of NATO and keeping that alliance together. Certainly, Trump is perhaps reluctant to explicitly say that he'd support Taiwan, were China to try and kind of unify in a kind of non-peaceful manner. So I think, there's potential other implications, and certainly the potential destabilization under Trump could also have some quite significant impacts on emerging markets, kind of depending on what else was to occur under those scenarios.
I guess then, in your view, are there some particular emerging markets that would be best positioned to capitalize on, whichever respective candidate wins, or as well for the Federal Reserve to cut rates, which it's widely expected to do?
I think in terms of the emerging markets, which are more attractive and potentially less reliant on US politics, I certainly think the Middle East is quite an interesting region at the moment. It's a region that has traditionally been quite a small part of emerging markets. A decade, it was about 1% or so of the emerging market investable universe. Today, it's 7 or 8%. And I think, the nice thing there is you have structural drivers which are very much independent of what's going on in the US, in that within Saudi Arabia, for instance, you have all these reforms that are going on that are essentially modernizing the economy and bringing more of the population into the workforce, particularly women, and that's enabling an increase in the amount of kind of consumers in Saudi and the wealth of those consumers. So, that's doing some quite good things for a lot of the Saudi-listed consumer businesses. So I think similarly as well in the UAE, Dubai and Abu Dhabi, there's a lot of immigration into those countries, which is generating structural growth in terms of banking services and starting businesses. So I think, those kind of markets are really interesting, and certainly, selecting companies in countries which are perhaps less directly impacted by the outcome of the US election is feels like a good way to go in terms of, we don't really have that much insight into what's going to happen in November in the US, whereas we have a fairly good understanding of what's going on in companies, at least within emerging markets.
I guess then perhaps then it might be obvious then what you might say, but are there any particular countries that you would be avoiding then?
I would say, places where we have less invested, kind of determined to some extent by the number of good quality companies we find in those countries. I mean, China is a bit of a tricky one. Obviously, there's quite a different governance framework of that country, and the government tends to be more involved in companies, which can bring some risks. But certainly, the valuations of businesses within China today are very cheap, particularly those kind of consumer, kind of growthy businesses that are more domestically driven. Those are the businesses which a lot of international investors have been selling indiscriminately, and the valuations of those are very cheap today. But, you do have to put up with what could be some continued volatility and tough times ahead, should the macro prove to be quite difficult. I would say, the other country which, historically we've avoided a bit has been, or we've had less invested in, has been Korea. And that's more of an issue with companies in Korea rather than, a kind of negative view on Korea itself. And it's really related to how the Korean kind of holding companies structures, the so-called chaebols, and the dominance of those types of companies within the Korean market. They essentially kind of have these holding companies which are run really in the interests of the families that control them rather than the minority shareholders who invest in small parts of those businesses. Although I would say there with Korea, actually the relative attractiveness today of that market has probably increased quite a bit in the last 6 months with the various kind of corporate value up program that's being implemented there, which is essentially trying to replicate what's been done in Japan in the last several years in terms of getting corporates to become more efficient and improve their governance practices.
So there were some other things that we kind of spoke about earlier on as well, and those are related to the green transition, tech revolution, a nearshoring of supply chains. I was hoping maybe we could kind of explore that a little bit more in terms of how that might be driving the investment opportunities in EM.
Yeah, so I mean, there's a lot going on in EM. I mean, all those themes to some extent have kind of tentacles within EM companies. If you think about green or the kind of green and energy transition, China, for instance, is incredibly strong in some of the companies in that value chain. So it has dominance in companies that make solar cells and solar panels for renewables. It's home to the largest EV, electric vehicle battery manufacturer in the world. So some great companies there. And then, thinking kind of further down that value chain, you also, within emerging markets, you also have the home of companies that are dominant copper producers on the planet and lithium producers, which are kind of key raw materials for the transition. So there's lots of opportunities there. I mean, nearshoring is a big EM theme. You would say it's probably negative for China, which it is, as more kind of supply move, or more companies' supply chains move out of China. I mean, China's offsetting that a little bit by their efforts to kind of localize, so to become less reliant on foreign imports. So you see the Chinese government really pushing companies like in the semiconductor space to try and catch up technologically. Similarly, Chinese software companies are being encouraged to develop software so they can replace Western software in Chinese platforms. But I suppose for the nearshoring, really, Mexico is the country that stands out that's really benefiting from that. And you're really seeing a massive uptick in FDI, foreign direct investment in Mexico as a result of nearshoring. And when we speak to companies in Mexico, we're certainly hearing a lot more opportunities to do that. And then, that third point, the tech kind of revolution and global tech capex. So, I mean, NVIDIA is obviously the kind of bellwether company that's benefiting from that, but there's a huge amount of companies in the NVIDIA kind of value chain, and a lot of them are based in emerging markets. So, Taiwan Semiconductor is the only company on the planet that can make NVIDIA's high-end chips. as the name suggests, they're based in Taiwan, and there's a host of other companies in Taiwan that are involved in all sorts of other parts of that value chain, like switching companies and companies that do testing of semiconductors. So, as much as the kind of most famous companies in AI, US based mostly, there's an awful lot going on in EM as well.
I guess in conclusion, though, if you could wrap up, I guess if you had a key message for investors in terms of, the emerging market outlook and, how they should play it, if you could explain.
Yeah, I mean, I think it's a good question. I mean, I think we're a little bit early at the moment, and so it's a bit of a contrarian play. But I think, these pieces aligning that you need for sustained outperformance of emerging markets. So, like I mentioned, the cyclical issues like the Fed, the structural issues in terms of CapEx, valuation's very cheap, and valuation is important because you need a good starting point when you're investing in terms of a valuation low enough to give you a lot of upside. And I think we're there today. And then perhaps the final piece of that puzzle is the fact that our clients, certainly investors in generally been reducing exposure to the asset class over the last decade. So there's an awful lot of dry powder out there that can be allocated into emerging markets. And EM tends to be a bit less liquid than developed markets. So a relatively small amount of capital being reallocated into EM tends to have quite a large impact on stock prices. So I think, if you're willing to be a bit contrarian and invest when, things don't look great yet, but willing to kind of hold those investments for a while, then now's a pretty good time to at least be kind of putting some chips on the table in EM.
Yeah, definitely. And I think that's an interesting point because, you're right. So, I mean, it is widely expected, yes, a tailwind will be the Fed slashing rates, but the US election is a big boogeyman, coming up. So just to reiterate, do you think it's time to, put some chips on the table and to start, kind of returning back?
Yeah. No, I think it's a good time to be accumulating. There's obviously risks out there, but to be honest, investing is about taking risks and being willing to, sometimes do things that are slightly uncomfortable. And it's the uncomfortable trades that often end up being the most profitable, because you do tend to make more money when you go from a pretty tough, unclear scenario to one which is only marginally better. So I think, there's a lot of value out there today. But, it might be a bumpy road to realize that. But, hey, that's investing.
Thank you very much, Nick, for your time. We really appreciate it.
Oh, you're welcome. It's been a pleasure to be on. Thanks for hosting.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.